Today, deposit safety is a matter of confidence. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed post covering finance and property news. Today, I want to discuss the thorny question of bank deposits and how safe they are, and in what circumstances might they indeed be at risk. Now, I've covered the issue of deposit bail-in previous shows. I'll put some links below. But Andrew Bailey, the Governor of the Bank of England, had some interesting comments in Washington this last week, and he specifically suggested that maybe the environment had changed, which meant that the whole question of deposit insurance and the issues around them need to be revisited. Now, these are very important questions, of course, because many people will have money in the bank, particularly with the higher interest rates that are now available, and this means that it's quite important to understand the basis on which money is placed within the banking system. Now, to get this underway, let's look at what Andrew Bailey, the Governor of the Bank of England, said when he spoke in Washington at the Institute of International Finance. One issue he touched on was this issue of deposit insurance. Now, it's worth noting two important points. First, the banking system relies on confidence, and in a crisis of confidence like SVB, money can drain away very quickly due to electronic transfer. Some reports suggest SVB had about 1/3 of deposits withdrawn within 24 hours, whereas the general assumption under a bank run is more like 20% in a month. Secondly, remember that when you place funds with a bank for safekeeping, you are actually making an unsecured loan to the bank. So while deposits are generally safe in the normal course of business, what happens in a bank run is very important. Now, Bailey said that the US authorities had announced a review of their deposit insurance system. In the UK, the bank is also considering improvements to their approach to depositor payouts for smaller banks which do not have eligible liabilities. Their work has so far focused on the speed of payouts, but going further and considering increasing deposit protection limits could have cost implications for the banking sector as a whole, he said. And as with all things relating to bank resolution, there is no free lunch. Now, when Andrew Bailey revealed in his speech that the Bank of England was working on updating Britain's deposit insurance guarantee scheme, which gives government protection on savings up to £85,000 in the event of a bank run, it was with one eye on the recent shocks and the other on events from 15 years ago. The final decision, by the way, to increase the UK's formal limit, which has been in place since 2017, would rest with the UK Treasury acting on recommendations from the Bank of England. Now, while Northern Rock, Bradford and Bingley and iSave may sound like names from another era, the memory of what happened in 2007 and 2008 still reverberates around the bank's Threadneedle Street offices to this day. The recent collapse of Credit Suisse and Silicon Valley Bank has brought back some very unhappy memories, situations that central bankers do not wish to find themselves in again. The last increase in the amount of savings protected under the Financial Services Compensation Scheme, the FSCS in the UK, was in 2010. And Bailey has this week made the case for increasing it from £85,000, noting it's far lower than the $250,000 offered in the US. And by the way, Australia also has a $250,000 limit per financial services license per customer. Up until the 2007 collapse of Northern Rock, when panicking customers queued outside branches in a desperate attempt to take out their savings, the FSCS only promised to repay 80% of the first £35,000 held in a failed bank or building society. At the time, to prevent a possible riot, the government was forced to guarantee that no saver would lose out from Northern Rock's failure, and so the FSCS would in future guarantee 100% of all savers' deposits up to the £35,000 limit. However, an even bigger test came a few months later, when the much larger Bradford and Bingley collapsed. Plenty of older customers in particular had far larger sums than £35,000 in their accounts, money they were relying on to pay for their retirement. Having bailed out Northern Rock, it was unthinkable that Bradford and Bingley savers with more than £35,000 would lose out. And to save the day, the government in effect nationalised Bradford and Bingley and forced the savings division on to what was then Abbey and is now Santander. Through a series of payments behind the scenes, all of the savers' money was protected, and the FSCS limit was soon afterwards increased to £50,000 with 100% of deposits covered. And the cost of FSCS of Bradford and Bingley's failure was £15.65 billion. But just as that crisis had been averted, came the news that the Icelandic banking system was in deep trouble. Millions of UK and Dutch savers and a number of councils and other public bodies had millions of pounds tied up in iSave, the online savings division of Landsbanki, a bank that could no longer meet its liabilities. Within days, it became clear that savers were in effect relying on the Icelandic compensation scheme, a scheme that had no hope of covering their losses. For a third time then, the UK government was forced to step in, with Britain's FSCS handing over £1.4 billion. These were just the big names that failed around 2008. In fact, a host of smaller lenders also collapsed, and their savers were in turn bailed out. And by the end of the financial crisis, the FSCS had in effect spent more than £20 billion rescuing the savings of millions of citizens. The crisis prompted a complete reordering of the city and the requirements for banks to ring-fence their deposits. In 2010, the FSCS protection was increased to £85,000 to bring the UK in line with the European standard that set the minimum compensation at around €100,000. And this is where it has remained ever since. Now, while most savers will not ever get near that level of savings, a surprising number of older people often have in excess of that sum in their accounts. And the 2008 crisis turned a lot of people away from investing in shares and led many to consider that they would rather keep their money in cash. Anyone selling a house or other significant asset can easily have more than £85,000 in their account at any one time. So when Bailey said the compensation scheme limit has to be looked at in the face of Silicon Valley Bank's collapse, what he was really saying is that the UK cannot go through this again. And by the way, at its spring meeting, the IMF advised separating monetary policy from considerations of financial stability. But it conceded that if financial conditions deteriorated significantly, rates would need to be cut to protect the financial system. In fact, Pierre-Olivier Gorenches, the IMF chief economist, said, if we were to find ourselves in a situation of a systemic financial crisis, then it's very clear that the objectives of financial stability take precedence over price stability in the near term. And he argued, however, that recent global financial problems were not near at all those conditions. So there's two really important points here. The first is that deposits are indeed at risk within the banking system if confidence drains away. And it's very important to understand the basis on which the deposit insurance scheme actually works. Separately, of course, there is this bail-in question where effectively deposits could be converted to equity to support a failing bank. And the interaction between the bail-in and deposit insurance is a long and tortuous discussion that I've had many times and I won't reprise now. But because the landscape is changing and money can be moved around much more quickly due to electronic transfer, it seems to me that this whole financial compensation scheme needs to be thought about much more thoroughly than currently is. It's very important that people have confidence in the banking system, because if they were to remove funds, then financial stability risks percolate up very, very quickly, as we saw just last week. So the other interesting observation from the IMF is that if you're trading off inflation versus financial stability, and if there's a problem, then financial stability comes first. And that means that we might be wearing higher inflation than we might think. So these important issues are ones which quite a few people, I think, have yet to get their head around. But if you are a depositor in one of the banks, I wouldn't worry too much, because it seems to me that if a bank were to fail and deposits were lost, confidence would be blown to smithereens and the banking system would collapse. In other words, financial stability would collapse. And governments and central banks can't allow that to happen. So my own view is, believe it or not, that I actually think deposits in banks are relatively safe, because we've seen, for example, in the US, where the Fed stepped in, and other examples around the world. And whilst there are some examples, like in Greece, when bail-in did happen and some people lost their shirts, to my mind, that's probably a bywater. The bottom line is this: financial stability comes first, all else comes second. Bankers and governments know this. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.